Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 22nd of April. My name is Fook Hien and I'm your host for the podcast. We're seeing a rather significant move in the foreign exchange or the FX market right now, which is the weakness of the US dollar. An index for the US dollar is the DXY index, and the DXY has been in a relatively stable range of 100 to 110 in the last 2.5 years. But we saw the DXY break below 100 recently on the 11th of April. Although it was still above 99, it was not a conclusive break lower then. However, over the last trading day, DXY has broken below 99, so it is looking like the market is really questioning the stable range of 100 to 110 for the dollar index. So what does this mean for investors? Well, in a big market move, investors should first be aware of the risk they face and manage their risk accordingly. With a big FX move, investors who are involved in a FX carry trade should review their positions. These are investors who typically borrow in a currency with low interest rates like the Japanese yen or the Swiss franc, and they invest the money they borrowed into assets in other currencies with higher interest rates, for example, the US dollar. Such a carry trade can make money from the difference in interest rates, and they also make money as long as the currency they invest in holds up in value, which is the US dollar in this example. What could go wrong is if the US dollar starts to weaken, it could lead to sharp losses on the exchange rate that more than offsets any gains that are made from the difference in interest rates. For investors who are involved in carry trades now, borrowing in currencies like the Japanese yen or Swiss franc, we believe it makes sense to diversify your borrowing into other currencies, for instance, the Singapore dollar. The Singapore dollar may have moderately higher interest rates, but it is less volatile. Diversifying where you borrow or diversifying your funding currency will help you manage your risk in case of a big FX move. A second strategy would be to simply limit the extent of cross-currency risk altogether. This means that if you want to invest in a certain asset, you fund your investment in the same currency. In this case now, our view on the US dollar is that it does appear oversold for now, which means it may rebound in the short term. Looking at dollar Swiss, it could rebound in the short term towards initial resistance at 0.862. And with dollar yen, it could rebound in the short term towards initial resistance at 148. However, a key assumption behind this view is that the DXY does not break down into a long-term downtrend. The more important implication now, we believe, is for investors with exposure to FX carry trades to manage their risk, since we may potentially see further big moves in the FX market. That's all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.